Hey, everybody. Welcome back to the Liberty Call for the last day of March, March 31st, 2002. It is a Thursday. Hope everyone's having a fantastic day out there. It is a beautiful day here in Colorado. It's a balmy 52 degrees, not a cloud in the sky. We got a little snow the other day. I mean, only about an inch or so, and it is mostly melting away, which is really, really nice. It means I don't have to shovel or get the snowblower out. So these are the things you look forward to when you live in the mountains. But anyways, like I said, it's a beautiful day. Not quite a beautiful day for the stock market. Was in the red most of the day, and then it took pretty much a dump at the last part of the afternoon. So not sure what quite did that. I know President Brandon was on TV talking about releasing the Strategic Petroleum Reserve, and we'll get into that in a little bit. But anyway, so yeah, kind of a weird day. Like I said, the markets were like in the red most of the all day long, but they really took a leg down in the afternoon. So not sure why. But all right, well, let's go ahead and jump into the news. Let's look and see how the indexes did so far today. The Dow Jones finished up down 1.56%, closing at 34,678. S&P 500 was down 1.57, closing at 4530. NASDAQ down 1.54. They're all about the same, closing at 14,220. Small caps were down 1%. The VIX jumped up 6.36% today, up over to bring us to 20.56. Let's see how the other Americas did. Canada was down. Brazil was down. Mexico was up over 1%. Getting into Eastern Europe, Germany down 1.3%. The UK down 0.83. France down 1.21. The Euro stocks down 1.5. What is that? Netherlands, I think. Netherlands down 1.32. Again, red. See, the first green I see here is Portugal up 0.5%. Then we got more reds for Belgium, Austria, Sweden, and Denmark. The Russian exchanges were up 7.5% each. Let's see, and then we get back into more reds. The only greens I see heading down are Turkey and Saudi Arabia. But once you get into the Asian markets, it is nothing but red, from Japan to Australia, New Zealand. All the Chinese markets were in the red. Not terribly. The worst one I see in China was the SE component, down 1.19. The rest were like 0.38, 0.76. And then some of the smaller Asian markets look like they finished in the green. So for the last day of first quarter 2022, not real great. So, but hey, we've had a nice little uptrend for the last, I guess about a week or so. Kind of a bear market rally is what I would label it personally. So, we'll see. Let's shrink this down back to normal. So let's look at the Dow Jones just today. So you can see, so we can see here about, what was that? 1 o'clock Eastern was probably the best the market did. And then it went from about 35,031 down, dropped about 400 points. So yeah, it was not ideal. Most of the day, the market was down 100, 150 points, and then it took a major slide. So anyways, all right, well, let's go ahead and get into some news for the day. The first one, just a market recap. S&P 500 cut some losses, but remains on course to end the quarter in the red, written by Yassine Ibrahim from investing.com. The S&P 500 cut some losses Thursday, but remained on track for a first quarter loss as investors digested further data pointing to red-hot inflation, just as President Biden announced the U.S. Plan to release a record amount of emergency oil supplies to curb rising energy prices. Biden said the U.S. planned to release 1 million barrels of oil per day from the strategic reserves over several months to stem the rise in energy prices. In total, up to 180 million barrels are set to be released over 6 months, which, if realized, would be the largest, quote, release from the stockpiles since it was created in 1975, end quote, Stifel said in a note. Oil prices fell more than 6% and were further pressured by a decision from OPEC and its allies, including Russia, to stick with plans to add 430,000 barrels per day from May, shrugging off calls from world leaders to ramp up production. Why would they? I mean, they're making a killing right now. I mean, I'm sure it's not really affecting them in the Middle East. So energy stocks, however, were one of the few sectors trading above the flat line, propped up by Pioneer Natural Resources, Baker Hughes, and Schlumberger. The latest economic data point to further evidence of the impact of energy and other commodity prices have pushed inflation well above the Fed's 2% target. The Federal Reserve's preferred inflation measure, the Personal Consumption Expenditures Price Index, excluding food and energy, rose 5.4% in the 12 months through March, the fastest gain since April of 1983. 83, that was a pretty decent year. I was in third grade. In the wake of red-hot inflation, Wall Street experts see the Fed following up its 25 basis point rate hike with more aggressive hikes this year. Morgan Stanley, JP Morgan, Goldman Sachs are forecasting the Fed to hike rates by 50 basis points in May and June. The bets on aggressive rate hikes ahead have many worried about the Fed causing a recession. Well, see, here's the thing. They should have thought about that 2 years ago before they added $6 trillion to the money supply, from going from 16 trillion to 22 trillion, where we sit today. So these morons knew exactly what they were doing. They were just trying to stave off a recession or a bear market two springs ago, which is what we were headed for. But the whole Corona cold put a nice little cover over everything, and it gave them the perfect excuse to flood the economy. So anyways, bond markets have been quick to price in the risk of recession early this week. The 10-2 Treasury yield curve briefly inverted following weeks of flattening. Bank stocks, which led the weakness on Thursday, remained on course to post a loss for the quarter as flattening in the yield curve dents net interest margin, limiting banks' profit from lending. State Street, Signature Bank, and Bank of America were the biggest decliners on the day, down more than 3%. Tech, meanwhile, was also in the red on the final day of the quarter as investors appeared to take profits following a month of strong gains for the sector. Chip stocks were under pressure following a 7% rout in Advanced Micro Devices, AMD, after Barclays downgraded the chip maker to underweight from equal weight, cut its price target on the stock to $115 from the $148 it had been, citing cyclical risks across several end markets. All right. So a lot of news there. As first the Strategic Petroleum Reserve release, 1 million barrels a day for the next 6 months. How much of that is really going to put a dent in the price of gasoline? I don't know. I mean, we burn through 20 million barrels of oil a day, somewhere between 19 and 20 million. So adding 1 million, I mean, that's only 5%. I mean, is that really going to make a huge difference? I don't know. Time will tell. It isn't a huge amount. I mean, if they were releasing, 30 million barrels or 20 million barrels a day for a month to see what that would do. I mean, that would flood the market and obviously reduce prices. But anyways, and then like I said, in the other things here, people worried about the Fed causing a recession. Well, I think the actions that, again, that they had 2 years ago are primarily the reason we're going to see an inflation, or I'm sorry, a recession, here in the next few months or in the upcoming year or two. But yeah, it is funny that these folks are just completely flummoxed. They're like, well, let's add all this money to the economy, to get us through this whole Corona thing. And then, 2 years later, they're like, this is nuts. Where'd all this inflation come from? I mean, weird. Anyways. So yeah, I'm a little more skeptical than most of these people. So, all right. Next article, USDA corn plantings forecast falls below expectations. It's written, it comes from Reuters. I don't see a author here. U.S. farmers intend to plant 89.49 million acres of corn in 2022, down 4% from last year and below the lowest in a range of trade expectations. The USDA said on Thursday for soybeans, the USDA projected plantings at 90.955 million acres, up 4% from last year and above most analysts' expectations. The USDA also reported U.S. March 1st wheat stocks at 1.025 billion bushels, the smallest since 2008. Corn stocks at 7.85 billion bushels, and soybean stocks at 1.931 billion bushels. Here's some of the comments from Terry Riley, senior analyst at Futures International. Quote, "We're pretty much going to need every acre the USDA reported this year in order to meet demand. The biggest surprise was corn coming in 2.5 million below trade expectations. That could reflect shortage of supply of fertilizer and also fertilizer prices trading at a record." Brian Basting, analyst at Advanced Trading, quote, "The bean acres number is a record, and we'll see if that is realized. When we saw the fertilizer price really skyrocket starting last fall, producers were looking for alternatives. They were looking at attractive oilseed prices too." Don Roos, president of U.S. Commodities, quote, "The corn number led the change. Acres were not good enough, and the stocks number was also less than the trade thought. It boils down to fertilizer costs, but the market jumps today. These corn acres can come back pretty fast." Jim Gerlach, president of AC Trading, quote, "USDA corn plantings forecast tells me that farmers don't like to pay for record fertilizer prices. They're either scaling back their fertilizer use or they have done a bit of switching of corn acres to soybean acres. They're just not going to pay these prices." Charlie Cernatinger, analyst at ED&F Man Capital, quote, "Wow, corn futures are off to the races on the acreage numbers as well as the spring wheat. New crop beans futures under pressure, but I suspect that even the beans will be bought up off these numbers. Total corn and bean acres were 180.5 million, matching the high from 2020. Bean stocks were bearish as well, adding to early selling." Craig Turner, senior ag broker at Daniels Trading, quote, "There should have been a bigger market reaction to these numbers. These should have been limit up, limit down numbers. They say a rising tide lifts all boats, and a rally in corn and wheat could be helping beans in this case." And lastly, Bob Utterpack, president of Utterback Marketing, quote, "Remember the movie The Exorcist, where the girl's head is spinning around and spitting out pea soup? That's what the bears are doing right now. Most of my farmer customers are planning to shift a little of their acreage to beans. It doesn't take a lot from all these producers making a small shift to add up an extra million acres." So I know I've been alluding to the food shortage that we may be having. Obviously, with increased fertilizer costs, farmers are going to have to make some tough decisions on what they're going to plant or not going to plant. Obviously, if you're in the farm business, you want to make the most out of your dollar, have a good return on your investments. And if corn is going to be a loss leader, it makes sense that a lot are switching over to beans. I've been aware of this, really for, I guess, 2 years now. When we were dealing with the whole Corona flu thing two springs ago, there were several people that people I listened to that have been talking about we're in a global solar minimum, which is going to lead to lower crop yields. Also, with some weather patterns that we're currently in globally, would lead to, again, less food for everyone. And then you throw on top of that the whole Russia-Ukraine thing. And if they're fighting a battle, they're probably not planting, wheat and other agriculture crops in their farm belt over there in Eastern Europe. So be prepared is probably my best advice. Have a couple of bags of rice and beans. That's what I have. Have some fresh water available or a way of making fresh water, because if things do get out of control for even a few weeks, you don't want to starve. So anyways, all righty. Next article, U.S. spending slows in February as stimulus fades, inflation bites, written by Jeffrey Smith from Investing. U.S. consumer spending slowed sharply in February as the effect of pandemic-driven stimulus programs faded and high inflation started to bite. Personal spending rose only 0.2% on the month, down from an upwardly revised 2.7% in January. According to figures released by the Bureau of Economic Analysis, that was comfortably below expectations for a 0.5% rise. That was despite the fact that personal income rose a more respectable 0.5% in a month when the effects of the winter wave of COVID-19 had already peaked. At the same time, the data series, widely seen as the Federal Reserve's preferred measure of inflation, posted another chunky increase, with the index for personal consumption expenditures rising 0.6 on the month, taking the annual rate to 6.4%. The core rate of PCE inflation rose 5.2%, both figures representing 40-year highs. Greg Dako, an analyst at Oxford Economics, noted that adjusted for inflation, spending had fallen 0.4%. Analysts viewed the PCE price index as a better guide to inflationary trends because it's quicker to reflect changes in prices of goods and services that are bought more regularly. The numbers provided fresh evidence of consumer spending reverting to more normal patterns after 2 years punctuated by lockdowns and dominated by working from home, push spending in the direction of home improvements and electronic appliances. The strongest gains were seen in food services and accommodation, along with recreation. By contrast, spending declined on most motor vehicles and parts and on furnishings. That trend may yet have further to run on. Oxford's Dacos noted that spending on goods is still 7.7 above its pre-COVID trend, while spending on services is nearly 4% below it. Other data released at the same time showed the initial jobless claims ticked up unexpectedly last week to 202,000, but continuing claims continued their downward run to a 60-year low of 1.307 million. Quote, the improvement is likely to continue, but remain unsteady as there's not much more room for claims to fall, end quote, said Daniel Ziho, chief economist at Glassdoor, via Twitter. God, these people, please proofread your work. The data comes a day before the Labor Department monthly employment report, which is set to show another robust gain in employment as the U.S. economy puts the pandemic behind it. The department's monthly survey of job openings released on Wednesday showed that vacancies continue to trend near record levels, while rising prices and thinning financial cushions, along with the lure of higher wages, push inactive people back into the labor force. I like how they put that. Inactive people. Most of us in the working world call those lazy people. So, all right. And last article has to do with the jobless claims numbers. Go a little deeper on that. Jobless claims, weekly claims rise to 202,000. Initial unemployment claims rose modestly after reaching a 50-year low as employers continued to show reluctance in reducing their workforces in the current competitive labor market. The Labor Department released its latest weekly jobless claims report Thursday. Here were the main metrics from the print compared to the consensus estimates compiled by Bloomberg. Initial jobless claims came in at 202,000 versus 196 is the forecast. And last week's was revised to 188. Continuing claims were at 1.307 versus a forecast of 1.340 expected, and they revised last week's to 1.342. Weekly unemployment claims edged higher for the first time in 3 weeks, but rose marginally from multi-decade lows set just last week at 188,000. Last week's tally for new jobless claims marked the lowest since September of 1969, and continuing claims, which track the total number of individuals claiming ongoing benefits on regular state programs, have also fallen precipitously and reached just over 1.3 million in mid-March. The last time it reached that level was in December of 1969. While weekly jobless claims data have been volatile, the reports over the past several months have shown a clear decrease in the number of individuals newly rendered out of work, while the quit rates has been elevated and last rose by 0.1 percentage points to reach 2.9% in February. Movement between jobs has also been high, with workers largely confident in their abilities to find new roles after leaving their previous positions. However, the relatively low numbers of new jobless claims belies the strain still facing employers who have still largely struggled to find enough labor to meet demand. However, some of this deficit has started to be filled, especially as jobs have grown for 14 consecutive months based on the Labor Department's monthly non-farm payrolls data. Job growth is expected to extend that streak in March in the forthcoming monthly jobs report due out Friday. Consensus economists are looking for non-farm payrolls to rise 490,000 in March based on Bloomberg data. While this would this would be slow compared to February's increase of 678,000. It would still represent a monthly gain well above pre-pandemic trends. An unemployment rate is likely to dip to 3.7%, improving to the lowest since February of 2020. Quote, on pace jobs growth in March would put the labor market on track to return to pre-pandemic employment levels this June, in quote, Daniel Zhao, Glassdoor senior economist, wrote in an email Wednesday, quote, the prime age employment population ratio is on a similar trajectory, only 1 percentage point below pre-pandemic levels, end quote. During the survey week for the March jobs report, or the week including the 12th of the month, jobless claims dipped to just over 200,000, hovering at about the same level as the weekly average from 2019 before the pandemic. Other recent reports have also offered hints at another solid month of job growth in March. On Wednesday, ADP reported that private payrolls rose by 455,000 over the past month, coming in a hair above consensus expectations. That also marked a fourth consecutive month of private sector employment growth above 400,000. So again, there are some positives out there. If our government would get the hell out of the way and stop making life hard on everybody and quit printing money, maybe we could get some sort of stabilization in the economy. But hey, again, I'm just some schmuck sitting out here next to the mountains, and no one really cares. So, all right. Well, that's everything I had for today. So if anyone needs something from me, feel free to go to dsafinancialgroup.com. My contact information is there. If you want to book a meeting or you have a comment you'd like to send me, feel free to do so. I'll be back tomorrow with the weekly wrap up, and we'll wrap up the first day of, or I guess tomorrow will be the first day of the second quarter, and it's April Fool's. So don't get tricked by anybody. Hope everybody has a great night, and I'll talk to you then. Bye-bye.